If you want to get rich from investing, index fund investing is one of the best investments you can make because they are super easy to manage and also super well diversified. If you aren't investing, you are literally costing yourselves thousands, if not tens of thousands of dollars throughout your life. In fact, Charles Schwab did a study of two hypothetical people where they gave them both $2,000 a year for 20 years. One person did not invest at all and left it in cash, whereas the other person invested literally at the worst time every single year. By the end of 20 years, the person with the worst timing imaginable had a sum of $121,171, while the person who stayed in cash had $44,438 to show for it, which is a difference of almost 3x. It pays to invest, and I want to show you guys why index fund investing can make you rich and why it's one of my most absolute favorite strategies ever, especially for beginners. Famous investors like Warren Buffett and personal finance guru Ramit Sethi of the Netflix show actually call it their #1 best way to invest and build wealth. Now, setting up this investment method will probably take you around 20 minutes, plus the duration that you need to watch this video, which is probably gonna be around 15 minutes. So for less than an hour of your time, under an hour easily, you're gonna be able to learn how to invest passively for the rest of your life. Maybe one day it buys you a fancy new car or perhaps a vacation to Paris. And if you do go to Paris, please invite me. I'm always afraid to go by myself because everyone there is super rude to Americans that don't speak the language. So if you could invite me, that'd be great. All right, so let's get into what index fund investing actually is. Now, it's actually a really good strategy for beginners, intermediate, and also advanced investors alike. Warren Buffett, in fact, has recommended it to the overwhelming majority of investors because of its simplicity. Now, investing in index funds is as simple as the following. You're going to move some money from your bank account to whatever investment account you have, and then you're going to purchase index funds. I'm gonna throw up a list of brokerages that you can look into no matter what country you're from. I've tried to cover as many countries as I can. I will say I'm a little unfamiliar with the international countries, but in the United States, I like Fidelity or Vanguard for a brokerage. An index fund is a type of financial holding that by buying that one fund, you get access to everything that it invests in. Think of it like a basket of stocks. A typical index fund will contain hundreds or even thousands of stocks, and its goal is to track an entire index. An index, for example, is like the S&P 500. It tracks the top 500 companies in the United States, or something like the NASDAQ, which you might have heard of. So an index fund would automatically track and invest everything that's in that index, making it a very simple investment. Let me give you guys a video game example. So I love video games, and back on the original Nintendos and Super Nintendos, you could buy these game cartridges, which would essentially have multiple games in one. So they often had titles like the best 100 video games, and by sliding that cartridge into your Nintendo, you could have access to all those games. An index fund is like buying the cartridge. You only bought the cartridge, which is the index fund, but you got access to all of the games in it for just one price. So if we pull up the S&P 500 index here, we can see that these are all the holdings within the S&P 500. We have Apple, Microsoft, Amazon, Nvidia. I'm sure you've heard of all of these. Apple has a market weighting of 6.88%. That means of the S&P 500, Apple is worth 6.88% of weight in the total S&P 500. As we start to scroll down this list all the way to the bottom, let's actually go down to the 400s or maybe the 300s here. We're gonna start to not really recognize any of the companies that are down here. For example, Huntington Ingalls Industries. I've never heard of this company in my life, never heard of it, but it's within the S&P 500 because it's one of the biggest 500 companies in the US. The idea here is that by investing in the S&P 500 index fund, your money gets split proportionally among all the companies in the top 500. So I would actually get to own some of Huntington Ingalls Industries if I did buy an S&P 500 index fund. The main advantage here is that you get diversification. Now, the concept behind diversification is rather simple. The idea here is that, let's say you're investing in a bunch of different companies. If one company goes bankrupt, you're totally okay and your portfolio is okay because you have so many other companies supporting your portfolio. Because if we think about the polar opposite strategy here, which is to go all in on one stock, if that stock goes bankrupt, then boom, all of our investment money is gone. Also, choosing one stock is usually not a really good strategy. So let me give you guys an example here. Consider the tech company Intel. They were once an amazing stock back in the dot-com days, but if you had chosen this stock back then, you can see by the chart that to this day, you would still not have broken through its all-time highs back in 2000. Compare that to the overall performance of the stock market since 2000, which has at least 4x'd since then. This is the danger of picking individual names when you know nothing about individual stocks. And so sure, there is more reward involved, but there is also a ton of risk. And that's a strategy that we don't want to do as a beginner. Another advantage of owning an index fund is that it is a passive investing strategy that usually outperforms active managers over time. So the key distinction here of index funds versus mutual funds is that usually index index funds are passively managed and mutual funds have something called an active fund manager. The fund manager within that fund is trying to pick and choose individual stocks to try to outperform the market. But as a result, because the mutual funds have this type of manager, it's going to be a lot more expensive to own. If you think about it, money managers are quite expensive. They need to pay for things like their own lives, their car, their family, food to feed their kids, etc. So what typically happens is that you start to pay higher fees to try to actively beat the market with a mutual fund manager, but oftentimes that doesn't actually happen. According to a Vanguard study, when choosing active management, quote, the costs of investing make outperforming the market significantly more difficult than the gross return distribution would simply imply. That just means in layman terms that if you're trying to beat the market, you're probably better off not trying to pay a fund manager at the same time as well. And that's going to be one of the biggest advantages of the index fund is that they have super low management fees. The average expense ratio or yearly fee of an index fund is around 0.06% on average. So that means $6 of a fee for every $10,000 you have invested. That's a pretty negligible fee that won't eat into your returns. Now compare that to the average mutual fund expense ratio, and it's actually 0.68% or around 11 times higher than that of an index fund. These particular fees will eat into your return over time, and that's why as a beginner investor, you want to just pick a simple investing strategy with the lowest fees possible. Now, it is important to note with index fund investing is that the shorter time period that you actually have, the less the fees actually matter. According to Vanguard, quote, a 50 basis point or 0.5 difference in fees may not greatly affect performance over the course of a single year. However, the same fee differential compounded over longer periods can make a significant difference in the two funds. So with that all being said, what type of index funds should you choose in your portfolio? We're going to talk about that after you click the subscribe button on this channel. If you like personal finance and investing content, I come out with it all the time. So make sure you guys are subscribed and also leave some relevant links for you guys down below in the description. All right, so I'm gonna put a list of the top 10 index funds that I personally think are great starts to starting any type of index fund portfolio investing. And you'll notice that there are a variety of them here, but most people on Reddit's personal finance and investing subreddits tend to enjoy the S&P 500 funds because they're well diversified and you're buying into the top 500 companies in the US. So each index fund here has a ticker symbol. A ticker symbol is like an airport code. So you know how like JFK references John F. Kennedy Airport or LHR references London Heathrow. Investments that you can buy on the stock market usually have their own ticker symbols or airport codes, if you like to call them that. And the first one on our list here is VFIAX, which you can see that it refers to the Vanguard S&P 500 Index Fund. When it comes to index fund investing strategies, most people like to go with 2 funds, 3 funds, or some people even just go all in on one index fund. I have a video on this as well, which I will link down below for you guys. The biggest thing to think about when it comes to investing in just one index fund is that sometimes that just doesn't give you enough international or bond exposure, and that's what many advisors will tell you. The thing I have with that though is that usually when you are investing in an index fund, many advisors will put you in what's called a target date fund, which means that the allocation changes as you near your retirement date. The thing is though, with target date funds, they'll have usually like a 10% bond allocation, and a target date fund is something that advisors will probably suggest you go into. But even a 10% bond allocation is rather low, even if it does increase over time. And the other thing is with advisors is that they'll sometimes push you to international stocks, but international stocks don't always perform. I mean, if we look at the past 10 years of international stocks, they've greatly underperformed US stocks. We don't know if those returns will continue in the future. They could definitely change. So that's the thing is with investing is that you don't know what's going to happen in the future. I don't know what's going to happen in the future. Nobody really knows. So just pick a strategy that you are okay with and comfortable with. And the idea here is that if the strategy allows you to consistently invest over the long term, that's more important. Now, personally, what I like to do is I like to invest in just one index fund, which is the S&P 500 Index Fund, VFIAX. The main reason that I like investing in index funds is that they are dead simple. They're as close to a set it and forget it type of strategy that you can ever come up with, and they're super well diversified. So even if you just buy one fund, you're already super well diversified, more than the average person. Now, for me, I used to be a financial advisor, but it doesn't mean that I was a good stock picker or a good stock trader. In fact, I am far from that. Since most people can't beat the market through picking individual stocks, and even Warren Buffett says that most people shouldn't be picking individual stocks and instead should be investing in index funds, I just do what Daddy Warren tells me to do, which is invest in index funds. It's easier, it's definitely less stressful, you're not really thinking about the market on a day-to-day basis, which is basically how it should be. You don't want to be checking the market all the time and going through these emotional ups and downs while you're shopping or trying to play golf. It basically allows you to spend your time investing in things that you actually care about, which is either making more money, which hopefully you can do that and then invest it into this passive indexing strategy, or it focuses your time on basically enjoying life, like your hobbies and time with your kids. The way I like to think about index fund investing is that basically it's working for me in the background and it's compounding my wealth over here. So as I'm focusing my time over here, which is hopefully making more money, that slowly I'm investing that money into the compounding machine that moves in the background. This strategy is very boring, but it will make you rich as long as you consistently invest in it. And if you're asking me, I'd rather be boring and rich than excited and super out of money. Those are probably some of the best reasons to invest in index funds. Now, I know when it comes to personal finance that people seldomly do what they actually should be doing when it comes to their own finances. I mean, people know what they should do, but in my experience, people need that extra push to kind of get motivated and get started when it comes to investing. Now, if you are inspired to take action, the number one question that I usually get is, when do I invest in index funds? The person asking this is usually not invested in the market, and they look at the stock market and they go, man, it's at an all-time high lately. I probably should wait before I invest my money, right? And they get a little hesitant and they maybe don't even invest, and 6 months goes by and nothing happens. So to ease those concerns, let's actually take a look at the data, because on this channel, that's what we like to do. We like to take a data-driven approach. So let's look back at the original study from the introduction. Charles Schwab looked at 5 different styles of investing with 5 hypothetical investors. Each person received $2,000 every single year for 20 years straight. The first person had perfect timing. His name was Peter Perfect. He invested $2,000 into the market every year at the lowest closing point, and he continued to time his investments perfectly for 20 straight years. The second person, deemed Ashley Action. That's just a funny name. She's like an action hero, but she takes action. Her name's Ashley. So if your name's Ashley, hopefully you're taking action. She just took her $2,000 and invested it on the first trading day of the year, so that's what she does. The next person, named Matthew Monthly. No, he doesn't have a monthly cycle. He just invested a 1/12 of the $2,000 every single month. This is known as dollar cost averaging in the investing world. The fourth person is the one that I want you guys to pay attention to. Her name is Rosie Rotten, and she has incredibly poor timing, probably also really rotten teeth. But in fact, she invested every single year at the market's ultimate top. And finally, the last person, his name is Larry Linger. He just left his money in cash for 20 straight years. Well, I think the results of this is gonna shock you, so let's look at this bar graph right here. Rosie Rotten, even the person who is the worst at timing, which is the worst possible timing ever, she still made close to 3 times as much as just staying in cash. And that's how much your inaction could be costing you right now. That's the opportunity cost of not investing. What's also really interesting about this study was that perfect timing here was obviously the one that performed the best. He had the perfect timing. I mean, he was a wizard, probably a wizard in the spreadsheets too, and in the normal sheets. But that's besides the point here. Investing immediately, Ashley Action versus dollar cost averaging, which is Matthew Monthly, it was pretty close. We can see that investing immediately edges out dollar cost averaging just by a little bit. But I wanted to include this study for you guys that are feeling a little bit anxious or hesitant to get into the market. The other concern that I get from a lot of people is that they are closing in on retirement, so they might be within, let's say, 15 or 20 years of retirement, and they don't know if index fund investing strategy is good for them anymore. I personally don't think it's ever too late to have some portion of your portfolio in index funds. And if you are, let's say, within 20 years of retirement, it's still a pretty good idea. Looking at the data historically, over any 20-year rolling period, investing in the market tends to return positively. So the blog of Dollars and Data summarizes how returns do every 5, 10, 15, 20, 25, and 30 years in this interactive GIF. And you can see that as more time passes, the negative returns slowly disappear and you see more and more positive returns. That means if you're watching this and you want to retire within 10 years, but you still want to start index fund investing, there will be some scenarios in which you lose some money when investing in index funds. However, as time progresses and the time horizon increases to 20 years, there's not a single scenario where you lose money in 20 years. I'm going to link this blog article down below for you guys to read after this video, but just know that if you are nearing retirement, that's when you need to really consider and balance whether or not you should be investing in index funds, which might be a high concentration of stocks. The possibility to lose money investing is always going to be there, but as this blog does show, if your time horizon is longer than 20 years, there's basically no scenario in which you would lose money. So that means if you are watching this video and you are on the younger side, it's probably a very good idea to start investing. So this has been how to invest in index funds if you are a complete beginner. I hope that this was helpful. Let me know down below if you have any questions, and I'm also going to link my next video, which is the video on a 3-fund portfolio right here, or perhaps over here. Thank you for being here. I'll see you guys in the next video. Subscribe. Peace.